Welcome to Corporate Finance. Welcome to Chapter 3, Problem Solution Videos, Ross Westerfield and Jordan, Fundamentals of Corporate Finance, 13th edition. And let's get going with problem number 1. In problem number 1, SDJ Incorporated has net working capital of $2,630, current liabilities of $5,970, an inventory of $3,860. What is the current ratio and quick ratio? Current ratio is simply current assets divided by current liabilities. Quick ratio, we subtract our inventory because it's the least liquid of the current assets to get to see how much cash we have available or liquid assets we have available to pay our current liabilities. And our net working capital is equal to current assets minus current liabilities. So to solve for current assets, I would have to switch that formula around, take net working capital plus current liabilities. My current ratio then is, using the numbers given, 2630 of net working capital plus 5970 of current liabilities, and divide that total numerator divided by 5970, current assets divided by current liabilities. And I get 1.44 times. I have dollars divided by dollars. That translates to times. My current assets then are 1.44 times my current liabilities. Quick ratio is simply current assets minus inventory. So that same number we solved for in the numerator of the prior problem, minus inventory of 3860, and that total numerator divided by 5970 of current liabilities. And I get 0.79 times for a quick ratio. And there are your answers to problem number 1. In problem number 2, we have Denver Incorporated with sales of $14.2 million, assets of $11.3 million, and total debt of $4.9 million. Profit margin or net return on sales is 5%. What is NPAT, ROA, and ROE? Net return on anything generally is net income over anything. So net return on sales, aka profit margin, is net income over sales. Net return on assets is net income over assets. Net return on equity is net income over equity. And you can see all these equations spelled out there. To get these, we need to first solve for net income. So net income is equal to NROS percent, which is given, or profit margin, also known as profit margin, times the sales number. So there I would take 0.05 of net return on sales or profit margin times sales of $14.2 million to get net income or an NPAT of $710,000. To get ROA, it's net income divided by total assets. So equal cell E19 divided by 11.3 million, and I get 6.2832%. And then finally, return on equity, I have net income over equity, equity being my total assets minus my total debt. It's because assets equal debt plus equity, assets minus debt equals equity. So I need equity for the denominator, so I take 710,000 divided by quantity 11.3 million of assets minus 4.9 million of debt, and I get a return on equity figure of 11.09%. Problem number 3, we have Dahlia Corporation with accounts receivable of $513,260, credit sales of $4.986340, and they want to know what is receivables turnover, what is days sales outstanding, how many days does it take for credit customers to pay. Basically anything turnover is sales over anything. So receivables turnover is sales over receivables. The only exception to this rule is inventory turnover, which is cost of goods sold over inventory. But in this case, this is not the exception. So I just take sales over receivables, and then I divide that number into 365 to get my days sales outstanding. So let's work through the givens, and I'm going to take sales of 4,986,340 divided by my receivables of 513,260 to get a receivables turnover of 9.7 times. I turn my receivables into sales 9.7 times per year. And then to find the days sales outstanding or days sales in receivables, also known as average collection period, I take that result and divide it into 365 days. So I take 365 for days sales outstanding equal 365 divided by cell E32, and I get 37.57, almost 37.6 days for customers to pay us. Now, when I worked in industry, our CFOs always wanted us paid within 30 days because the bill at the top of their stack that they had to pay was our payroll, and very, very important. So they always are very adamant about keeping our day sales outstanding to 30 days. So you may want to keep that in mind when you're a CFO someday also. You may encounter that when you go to work, that your CFO is making sure that you collect your receivables in 30 days or less. There are your answers to problem number 3. In problem number 3.4, the top corporation has inventory of $426,287, a cost of goods sold of $4,738,216. What is their inventory turnover? What is their days sales out in inventory? Days sales in inventory. How long does inventory sit on the shelf? The equation in this case is inventory turnover is cost of goods sold over inventory. This is the only turnover equation, which varies from the mnemonic that I provided in the chapter lectures. Normally anything turnover is sales over anything. In this case, we must use cost of goods sold over inventory because cost of goods sold and inventory are closely related. Days sales in inventory then is equal to 365 days divided by inventory turnover, stated in time. So the solution, inventory turnover is $4,732,216 divided by the cost of goods sold, $426,287, and I get an inventory turnover rate of 11.12 times. Again, dollars divided by dollars, the units are in times. So I turn that inventory over 11.2 times per year. Inventory turnover, days sales, this should be days sales to inventory, so DSI is equal to 365 over that 11.115 times, and I get a days sales in inventory of 32.838 days. So it sits on the shelf for about 30 days, and you can judge whether that's too long or not. In problem number 5, Mobius Inc. has total debt ratio of 0.57 times. What is their debt to equity ratio and their equity multiplier? The equation is total debt ratio is total debt over total assets. I wish they would call it the debt to assets ratio, but they don't. They call it the total debt ratio. So total debt over total assets is the same thing as total debt over debt plus equity. Is another way to look at it. And total assets are total debt plus total equity. So we can use that knowledge to figure out the components because you're not really given a whole lot of givens in this problem, just total debt ratio of 0.57. So to solve it, my total debt ratio then is 0.57 over 0.57 plus 0.43, or 0.57 divided by 1. That's how I came up with that. And then my debt to equity ratio is just 0.57 over 0.43, 0.57 of debt, 0.43 of equity, and I get 1.33 approximately times for debt to equity ratio. And then equity multiplier is just assets over equity. So I could call assets 1 and equity 0.43, and I get 2.33 times. But it's also equal to the equity multiplier more easily recognized as 1 plus debt to equity. And so I take 1 plus that debt to equity ratio, 1 plus cell E50, 1.32 equals 2.32. It's 2.33 roughly times for my equity multiplier. In problem number 6, we have that Bolton has additions to retained earnings of $435,000, dividends of $245,000, equity of $5.7 million, shares outstanding 175,000 shares of stock. And this stock sells for $78 per share. What are the earnings per share, dividends per share, market to book ratio, price to earnings ratio, price to sales ratio? This company has sales of $7.45 million. So let's go down and calculate the earnings per share, and that is just earnings or net income divided by shares outstanding. Now, how do I get my net income. That's equal to additions to retained earnings plus dividends, if we look at that net income pie. So I take $435,000 of addition to retained earnings, $245,000 of dividends, and then divide that total numerator by 175,000 shares, and I get roughly $3.89 per share for earnings per share. Very important ratio. Dividend per share, or simply the dividend dollars divided by shares outstanding. $245,000 of dividends divided by 175,000 shares outstanding, and I get $1.40 even per share. Book value per share. Book value is the same thing as equity. Equity has many different names. We can call equity, it's commonly referred to as shareholders' equity, stockholders' equity, book value, net book value. So a bunch of different names, and just sometimes equity. I just call it equity sometimes. So book value is the same thing as equity. It's assets minus liabilities. So I'm going to take equity of $5.7 million, which was given, divided by 175,000 shares, which was given, and I get a book value per share of $32.57 per share. Market to book ratio is the market price or market value per share of $78, and that was given. And then I'm going to divide that by the book value per share that I just calculated above of $32.57, and I get a market to book ratio of 2.4, approximately 2.4 times. So is this company doing well at creating value? Yes, their market value is 2.4 times their book value or original historic cost. Price to earnings ratio, PE ratio, as it's referred to as price per share divided by earnings per share. Price per share was given at $78. Earnings per share was calculated up above in cell E65 of $3.88. So I can take 78 divided by that cell right up there of E65, and I get 20.07 times price to earnings ratio. And then I can compare that to any other company in the world once I calculate this company's PE ratio. And then finally, price to sales ratio is price per share divided by sales per share. In this case, I have to calculate sales per share. Sales were 7.45 million. Shares, 175,000, that was given, and I divide that into $78 of price per share, and I get 1.8322 times. Those are your answers for problems 4, 5, 6. In problem number 7, Rogers Inc. has an equity multiplier of 1.43 times, total asset turnover 1.87 times, and a profit margin of 6.05%. And they want to know what is the return on equity percentage. ROE, according to the DuPont identity, is profit margin times, or net return on sales, either or, times total asset turnover times equity multiplier. And then my solution is very simply by multiplying those three givens, 0.0605 for profit margin, 1.87 for total asset turnover, and 1.43 for equity multiplier. And if I multiply those three together, I get 0.16178 or 16.178% for ROE. There's your answer to number 7. And for number 8, Jackson Corp has a profit margin of 5.8%, Tato of 1.75 times, and 8% ROE of 13.85%. What is the firm's debt to equity ratio? Sometimes that's posted by your finance prof as B to S ratio. So equation is the same one as in the previous problem. Percent ROE equals profit margin times total asset turnover times equity multiplier. And also, since equity multiplier is 1 plus debt to equity, I can solve for debt to equity by taking equity multiplier minus 1. So down there in the solution then, I simply set up both sides of the equation. So for ROE is 0.1385, that's equal to profit margin of 0.058 times 1.75 times the equity multiplier. And I solve there and I get an equity multiplier of 1.3645 times. Then to get the debt to equity ratio, I simply subtract 1. So I take the cell above minus 1 and I get 0.3645 times. There are your answers to problem number 8. In problem number 9, looking at Ortiz Corporation again, did cash go up or down? By how much? and classify each event as a source or use of cash. In general, if a left side balance sheet item goes up except for the cash account, it's a use of cash. And if a right side balance sheet item goes up, it's a source of cash. So let's look at Ortiz Corp. Decrease in inventory of $425. That is a left side balance sheet item going down. That's a source of cash. If inventory goes down, that means we sold some inventory and we got some cash. So source of cash, $425. My accounts payable decreased by $230. That's a right side balance sheet item going down. That's a use of cash. My payables were paid off. Use some cash. My notes payable, also on the right side of the balance sheet, went up $280. So I borrowed some money. So that's a source of cash, $280. And my accounts receivable, left side balance sheet item going up, that's a use of cash. So negative $290. Add all these together, and I get a total increase of cash of $185. And there are your answers to problem 789. In problem number 10, Dexter Inc. had a cost of goods sold of $75,318. Their accounts payable balance was $18,452. How long did it take the company to pay off its suppliers during the year? What might a large value imply? Payables turnover is cost of goods sold over accounts payable, and days sales and payables is equal to 365 over payables turnover. And then to get our solution, our cost of goods sold is $75,318, accounts payable $18,452, and your payables turnover is equal to your cost of goods sold, which is D108, divided by D109, 18,452, or your accounts payable, and I get a turnover of 4.08 times. I turn over my accounts payable 4.08 times per year. How many days sales are out there in payables? I take 365 divided by cell D110, or my payables turnover, and I get 89.42 days. What does a large value imply? How long it takes you to pay off your suppliers during the year. So that as that number goes up and up, it takes longer and longer to pay off your suppliers. Probably have some irritated suppliers along the way. Number 11, Nina Inc. has market value of $755,000, $63,000 in cash, and $220,000 in debt. Their EBIT is $95,000. Their depreciation amortization totals $178,000. Find their enterprise value to EBITDA ratio. The equation is market value. Enterprise value is equal to market value of the shares plus debt minus cash. Sometimes they add in preferred stock also, value. In this case, we're not going to do that. And then enterprise value to EBITDA ratio, which is used heavily in merger and acquisition analysis, is equal to that enterprise value divided by EBITDA, which comes off the income statement. So enterprise value, filling in the givens, is equal to $755,000 of market value plus $220,000 of debt minus $63,000 of cash. And I get enterprise value of $912,000. My EBITDA off the income statement is EBIT of $95,000 plus DA, or depreciation and amortization, of $178,000, and I get EBITDA of $273,000. And my enterprise value to EBITDA ratio is cell E120 divided by cell E121, and I get 3.34 times. So enterprise value of the company is 3.34 times its EBITDA. And again, these can be compared to other recent acquisitions in the space to see if you are paying a fair price, or someone is paying a fair price for your company, or you are paying a fair price for a company you're acquiring. Finally, in problem number 12, Kodai Company has a debt-to-equity ratio of 0.63 times, return on asset of 8.4%, and total equity of $645,000. What is their EM? Their ROE, equity multiplier, their percent ROE, return on equity, and their NPAT, or net income. So looking at our equations, equity multiplier is 1 plus debt to equity. Also can be calculated with assets over equity if you're given that. But in this case, we're going to figure out the equity multiplier by adding 1 to the debt to equity ratio. Percent ROE is ROA, return on assets times equity multiplier, which is also known as debt to assets ratio. And MPAT, or equity multiplier, is 1 plus debt to equity. Yeah, that's the way we're going to calculate it, 1 plus debt to equity. And MPAT is equal to ROE times total equity, which will give us our net income number. So equity multiplier is 1 plus debt to equity, or 1 plus 0.63 times, or 1.63 times for equity multiplier. ROE is ROA times equity multiplier, which I had that flipped. It's assets over equity. So the assets cancel out, and I'm left with return on equity. So 0.084, which was given ROA, and the equity multiplier, which we calculated to be up in the prior cell to be 1.63, and I get an ROE of 0.13692%, 13.692%. Finally, my net income is ROE times the equity number. So I get 0.13692 times $645,000 of equity, and I come up with a net income of $88,313. And there are your answers to problems 10, 11, and 12.